We're here, sir.
Why is it taking years to answer me now? Can you please start recording?
Okay.
All right. Looks like we're good. Yeah. So yeah, so back to the question, what could be the behavioral reasons why tech companies have that kind of valuation? That's what the examiner was asking. So what are your views? For you to understand what the question is saying, sorry, just one moment, please. For you to understand what the question is saying, the examiner is asking, fine, a company could be valued, high on a rational basis, that is, through rational analysis, a company may have a high valuation. But they're then saying that from a behavioral perspective, and behavioral, as you know, is a rational assessment. Okay, what could be the possible behavioral factors that could have led to what's the name, this tech companies and the likes, in this question to be valued high? So I'm listening. Go ahead. Yeah, go ahead. Okay, Samuel, go ahead.
Okay. So on top of my head, what I could think of is that some shareholders or some investors actually just go ahead to buy shares when they see others buying. Just because people are buying a particular shares, they tend to feel that there is some, in quote, there is something they're probably seeing that they don't know. So they just buy because other people are buying, not because they do any rational calculation, but just because other people are buying, and then that tends to put upward pressure on the price of that particular share.
Good point.
So that's valuation. It's not because, okay.
Thank you. Yeah, I think that's very clear. Moya, go ahead.
Can you say that is Eda's instinct or something?
Yes, that's what it is.
Okay, thank you.
Is it herd behavior too?
The same thing.
Okay.
Yes. I see that you people have read.
It's called the Ashobi mentality.
That's another name. In case you don't know what Ashobi is, you can Google it. Don't worry, Google has answer for everything. So Ashobi mentality is also another name. Moya, do you want to say something? Okay, any other points?
Hello?
Yeah, go ahead, John.
So I was just thinking with regards to tech companies. So investors typically believe tech companies are a high growth company, right? And that their prospect of making profit in the future is high. So because they are high growth, there is a prospect for them to make higher revenues in the future. And as such, based on that sentiment, they would buy into such companies. They want to buy into such companies early enough, which would drive up the price of such companies and the valuation of such companies.
All right, good points. So, what name do we call that bias?
Overconfidence.
Well, not necessarily overconfidence. So,
Overreaction bias.
Overreaction. Okay.
Or anchoring.
Confirmation bias.
Oh yeah, confirmation.
Cognitive.
Yeah, so I may lean more towards confirmation bias, but sorry, let's be on mute. Let's be on mute. Thank you. So yeah, I will tend to lean more towards a confirmation bias, but that description is really more like what market perception is, right? And so because of that market perception, you anchor your decisions on that. So you may also say it's a form of anchoring bias. So at the end of the day, really what matters is how well you are able to explain it. Now, John didn't use any special name, but his point was clear, right? Yeah. So, Chinaya, go ahead.
I don't know. Okay, sorry. Yeah. So what I was thinking of is a situation where you have more of institutional investors or foreign investors. So like because so I'm thinking in terms of FPI now, like foreign portfolio investors, where most times just the volume that they choose to purchase, just has a way of driving the share prices up. So you might really have just maybe few domestic investors just investing, but because of their volume and the funds they bring into like buying the tech companies because of maybe the prospects they see based on maybe what the market is doing and what they have over there in their own countries. So in terms of the volume they might want to purchase, it has a way of driving the share price up. I don't know if that makes sense.
Yeah. Yeah, okay, so it makes sense, but I'm struggling to see whether it answers the question. That's the problem. So because we're talking about behavioral factors, right? So I think it's that link that I'm not able to get.
Okay.
Michael, go ahead, Michael.
Yeah, hello.
Go back on mute. Please, if you are logging on with 2 devices, then there's a chance that you would have to not only mute one but also reduce the volume, and then you can come back. Yetunde, go ahead.
Okay, just in line with what Chine has said, may I say that now, considering the nature of the kind of investor, so for instance, now, if I want to invest in a company, if Shay has invested, it's a no-brainer. I have to buy it because I feel like Shay has already done due diligence. He has done everything he needs to. So I won't even think about it. I'll just go ahead and buy. So when you look at the nature of those that have started investing and you think that, okay, maybe they're high net worth, you think that they're good companies, they would have done due diligence and done all their assignments, then people just go ahead and buy it. I just think so.
Yeah. That's very true. And that thing has a name, and I don't know the name for now, but I can get it. And sorry,
Information cascade or something like
I'm not even sure if that's what I had in my mind, but I can check. And so there's something around Warren Buffett has bought or is investing in Coca-Cola, or is investing in Apple, and so fund managers are trying to move their funds accordingly because of his prestige. Yeah, well, I'm happy that I'm also in the ranks of Warren Buffett, according to Yetunde. All right. I
Hello,
think
see,
I'm
please keep
fine.
on.
Y-
Yeah,
yes, go
I
ahead.
just have a question. So, what actually differentiates what she explained now and the hedge behavior? Like, seems there's a relationship between both of them.
Yeah, but it's the degree. So it is everybody is doing it. That's what's in town now. Like most portfolio managers or asset managers are investing in it. What she explained is, you base your decision on what one very influential individual has done. Do you get the difference? Yeah. Okay. Brand, you want? Okay, Michael. Yeah, it's better now. That would be the last. Yes.
Okay, so my point is it could be explained by anchoring. That is like maybe given that tech companies are highly profitable and then there is future expectations of profits. So the target company can be, because based on general knowledge, they can just demand a high price. So it becomes a benchmark. So because they are already asking a very high price, instead of you being rational, you now maybe they're asking for 20 million, and then realistically you could actually get it for 10 million, then you go for 18 because you already expect that, okay, yeah, this is a profitable company, and that, so that they won't be so far away from the asking price. That's one. Then also loss aversion, given that also the buying company, bidding company considers the target company very profitable, and with all the expectations and the plans that the bidding company already has for the target company, he becomes so attached to it that he doesn't want to lose it to another bidder. So they go up and pay higher than they should have.
Yeah, very good. I think and I still see more hands. So please, let's move on. I think I've gotten quite a number of points. So thank you very, very, very much. So what I have here is really the first one Mike talked about, asking price, and he linked it to anchoring buyers, and that's very good. So anchoring buyers basically is saying, if you're not on mute, please be on mute. So it's basically saying you are allowing your decisions to be anchored by the first information you got. Okay, so if you got the information, let's put it this way. If someone is already saying the price of this thing is $20 million, it's difficult for you to start your negotiation from, $5 million, because that price that they've already set high up there already gives you that, expectation, or influences your judgment to think that, oh, maybe I'm actually undervaluing this company. It's actually worth a whole lot more than that. It's just like you see a product out there, maybe a fairly competitive product is 100 naira, but then this person starts from 1,000, and you're like, okay. And so if you negotiate and you discount it to 800, you're like, oh yeah, I did very well. But meanwhile, it's already overpriced. So the asking price sometimes may be so high as to create that impression that the asset or the business is highly valuable. Okay. Loss aversion bias, so you don't want to lose out. Okay. not wanting, to lose an opportunity. So this one is really more of saying, I don't think I'm going to ever find this kind of tech company being available for sale, just like that. So I'm going to do everything possible to ensure that I buy it, because opportunities like this are rare. You understand? So that's really what that is about. So for that reason, you may really not follow rational analysis to determine a fair value, for what you want to buy. Information availability. I think this is quite straightforward. So what this is saying is, if a company is put out for sale is also equivalent to information being available. So a buyer often tends to place a higher premium, or valuation, perception-wise, for such a company than another company that it has no information. So no information about the company, maybe because it's not being put for sale, you can't do due diligence, you can't know anything that is hiding anywhere. So you are not likely to have how do I put it? Put as much value, lower value for such. In fact, there's something called information asymmetry discount. So if you just want me to buy something and I don't know a whole lot about it, I'll be willing to pay less. That makes sense, right? But if you give me more and more information to justify why you think profits will be made, why you think you've disclosed all your liabilities and all of that, then I'll be happy to pay a premium for the value of information that I was able to get. So the fact that Matravas Tech, is available, is put up for sale, may also mean that, they've cleaned their books, things are fine, and they're happy to share that information. And that typically will give it a better valuation. Okay, head instincts, I think we've explained that. So that's really more about share price going up because people are investing in the sector. There's a lot of other investors, buying the shares. Other investors are buying the shares. So you two just, seems it's Seplat that is selling now. Everybody wants to invest in Seplat, or everybody wants to invest in whatever, and then you put your money in it. So herd instincts can also result in a company's valuation going up. Portfolio updates. So another possible reason could be fund managers or asset managers or portfolio managers. So portfolio managers, particularly active portfolio managers, active management means that you are trying to beat the market. So that's what active management means. Active management of a portfolio means you are trying to beat the market. So to beat the market, beat the market. Is that BEAT or BIT? Beat the market. Okay. I think it's BIT. Please correct me. Is it BIT or BEAT? I'm mixing that up. Huh? So, but you know what I mean. Okay. All right. Thank you. So if I put my money in, with a portfolio manager and I say that, give me treasury bills or treasury securities are currently giving 5%, and you say, oh, don't put your money in treasury securities, I could help you trade with your money, buy stocks, buy bonds, buy currencies, and I can give you 15%. So you're telling me you give me a higher return. typically I will need to see evidence that you are buying and selling in my portfolio. Do you understand? As a means towards generating that return. So portfolio managers like to create that perception that they are, investing, selling, buying, and all of that. So most times what they do is they often tend to buy companies that are involved in current developments, okay? Companies that are involved in more recent technologies or ways of doing things, okay? So send a perception of active management, which is buying and selling of portfolios, through portfolio rebalancing, okay, particularly buying stocks. Expected to generate higher returns. And this will typically be what tech stocks that are moving with trends. Okay, confirmation bias. So in this case, you can easily talk about what you guys were saying earlier on, views about the sector. Okay, views about the sector. So if generally there's some positive views, and obviously generally there's positive views around tech sectors. In Nigeria, some days back, some weeks back, we started hearing Flutterwave is more valuable than a lot of banks in Nigeria, except for maybe Zenith and GT Bank. Okay, it's more valuable than First Bank, it's more valuable than this. And when did they start? They only started differently. They don't even have branches. It's online. You hear all sorts of
Please, your voice is not very clear.
Is it me or you?
It is very clear here.
Aha. My NASA insured internet connection works well. Okay, so check your own connection. As I was saying, you can't see my screen. Check your connection. Can others see my screen?
Yes, please, I can see.
Yes.
Okay,
Yes.
good.
Yes, sir.
So you remember also there's this perception that if you pick the world's largest or America's largest 50 or 10 companies, 50 years ago or 20 years ago or 40 years ago, or let's say 30 years ago, and you compare it with the top 10 companies, in the last 3-4 years, you will see that none of these 10 companies is even on the list now. 30 years ago, you would not have seen Amazon, you would not have seen Microsoft, you would not have seen Alphabet or Google, you would not have seen Facebook, you would not have seen those guys. So there's that general perception that tech industry is making more money, is having higher valuation, is having more future prospects, they're able to reinvent themselves and things like that. So confirmation bias is just basically relying more on information that confirms that perception that you have and information that you have about the industry or the company. You guys can also talk about overconfidence bias. You won't be wrong if you talk about overconfidence. The management team at West Valley may just think that they can actually make more money than current valuation of or current price of Matravers Tech, by being able to sell it at a higher. So they may just be overly confident about their abilities, overconfident about abilities. They may, for example, say, oh, we can buy it, restructure it, and sell it, and we believe we will make a gain of 30%, regardless of the fact that that valuation is overly optimistic or too high, if you get what I mean. All right, so I think we can skip this. Yes, sorry, just a second. While we go on to
Hello, Shay.
Yes, please.
While you are still navigating, I just want to ask this question. If you look at the requirement, it doesn't suggest that looking at it from the angle of Westpally, it's saying that discuss the behavioral factor which may lead to businesses such as Matravers take value highly. So if we give a point on it from the angle of Westpally, if you are the examiner, will you mark it? Will you give us?
Oh, yes. Matravers is the target. Who influences the price of the target? It's not just the target itself, but also the buyers. So who is the buyer in this case? Westpally. Do you understand? So all the questions people have been saying about herd instinct, people buy because of one influential person, is it not from the buyer's perspective? Yes, so we're looking at what typically results in such companies being overvalued or having excessive values that is not based on rational analysis. So I hope you get the point.
Yeah, I get it.
Yeah. All right, so I go to my Excel now. And once you see Excel, you know it's time for computation. So let's see what B1 is saying. B1 says, prepare a report for the board of directors of West, which we know that our report will be on the word processed document. Remember, you will only have one word processed document and one spreadsheet, okay? So all your calculations, everything you need to do that you want to submit goes into the spreadsheet. Everything you want to write to explain goes into the Word document, okay? Of course, basic computations, 2 plus 2, you don't have to go to Excel to go and do that. So you can always put that in your Word document. So the examiner expects you to use judgment in deciding, as you will decide in practice, what you want to put on the body of your report and what you want to put as an computational appendix, which will be on your spreadsheet, okay? So compares the additional value that West believes can be generated from the sale of Matravers Tech based on the PE ratio with that of the projected present value of free future cash flows. Very easy, 4 marks. So what do? We first of all go to the paragraph where they give us that information. We are told, they told us on the first page, just after Matravers Tech, they told us, they told you and I that the current market valuation of Matravers shares is this, and the debt currently trading at its book value. Westpally believes that it will have to pay a premium of 15% to Matravers shareholders to buy the company. Now watch this. West intends to take advantage of the current values attributable to the businesses such as Matravers Tech by selling this part of Matravers at the relevant price to earnings ratio of 18 rather than the forecast estimate of Matravers Tech present value future free cash flows of 4,500 million. So let's get to that. So what do I need to do? So obviously this is B1. So I can put the heading, as I've always told you, you know, always use heading. So they say we should estimate the value created. So I can call it value created from the sale of Matra Tech. Okay, so this is PE ratio valuation. So how do we do PE ratio valuation? PE ratio valuation, PE valuation is based on what? The relevant PE times the earnings, right? Earnings, and the earnings you will use, in fact, let me not say earnings, let me call it profit after tax, so that you remember that clearly. All right, so in that case, what will that then mean? We need to get the profit. We are given the profit for the entire Matravers, is that not true? Which is 1950 million. So everything I'm doing will be to the nearest million. But then they also give us the share of the business that Matravers and the home business constitutes. Can anybody remind us what is that? Where did they say that again? Say for where are you? Where are you?
Yeah,
You see why it's
after
important to
the
underline?
Just after the financials.
Oh yeah, just after the financial. The share of pre-tax profit between Matravers, Home and Tech is 80-20. So I go there and then I say share of parts for this company, that will be 20% of 1950. So that gives me 390. Then I need to get that. Okay, the profit is actually profit pre-tax profit. So I need to apply taxes, and they said tax rate is 28%. So that will be 1 minus 0.28. Okay. So that gives me 280.8. Since they said the PE ratio for the sector is 18, now that's a consideration. If we are just using that potential sales proceeds, so that would be what? 18 times my expected earnings, 5,054. So since the free cash flow valuation is 4,500, then it means excess value created will equal this minus this. Okay, so that's that for that one. Yeah. Any question? So I say that. Go ahead.
Which parts? Can you please go over that 281 again, please?
Yeah, no problem. So 20% is the tech business in the whole business, right? So 20% of the profit, but that profit is pre-tax. So that's why I had to apply the tax rate, 1 minus 0.8 to make it post-tax. And that's what gave us 281. Remember, our objective is to do what I stated here, to get the PE valuation based on price earnings ratio times the profit after tax. All right, so let's move to B2 if there is no further question.
Is the FCF in negative? Is it in jacket?
Yes, so not necessarily in jacket. So, well, to get the final answer, yes. So effectively, I subtracted our sales proceeds from this. Remember, what they are asking us is how much extra value do we think we will get if we are able to sell the company rather than its value in use? That is, if we continue to hold on to it. They've said that based on free cash flow valuation, fundamental valuation, the value is 4,500, but they believe they can sell it based on, you know, PE ratio valuation of 5,054. So yes, you are correct. It's 5,054 minus 4,500. That gives this. I think I can move on. So the next question says, yes.
Hello. Hi, Shay. Sorry. Just a quick one. So the question really said whether the free cash flows were either to firm or to what do you call it, equity, right? And in this case, we're assuming it is to equity, which is why we are subtracting, right? So I'm just thinking if we would need to have stated that assumption as well, to say assuming the present value of the free cash flow is to equity, or if we should just take it that, you know, where it doesn't state that it is to equity.
Okay, so I get what you're trying to say, right? But number one, it's okay to state what you are saying, that this 4,500 you believe is based on free cash flow to equity valuation. Okay, remember it could also be based on free cash flow to firm valuation, but as long as they've deducted debt in arriving at that value. But where I'm even going to is there is no other, you know, thing you could have done. The long-term loan that you have there, they never told you anything about what proportion applied to home or to tech. You understand? So pretty much the intent here is really comparing valuation from PE ratio with valuation from free cash flow. So but I get your point anyway. And it won't be a problem if you state what you are saying. All right, looks like no other one. Okay, so calculate the weighted average cost of, yeah, fine. Calculate the weighted average cost of capital for the combined company. Okay, so as usual, I would have to go back to my stories and start putting together the information I will need. One of the benefits of the CBE exams is that they would have categorized the information for you, because the format is such that yeah, so the format is such that on the left side of your screen you will have every information about the case study in facts. So whether it's background, cost of capital, pre-acquisition, intention for matravers, post-acquisition, you know, such that if you click on each one of those extracts, you can read the information you need there. So for example, here, this post-acquisition cost of capital that starts from the first page will have been an extract, you know, ideally. All right, so post-acquisition cost of capital of the combined company will be based on the cost of equity and cost of debt. We know that already. Why tell us? The asset beta post-acquisition can be assumed to be both companies' asset beta weighted in proportion to their current market value of equity. If they did not tell us, we know that that's what we are to do. I'm correct, Abi? Yes, because the asset beta of a big business or of a business is the weighted average of the asset beta of the components, the business units that make up that big business. Okay, and we have always said that because it is asset beta, the weight you should use should be the current market, should be the equity weights based on market values of equity. Although if the examiner tells you to use total capital, which is debt and equity, please follow that instruction. All right, West has number 4,000 million number of shares, trading at 8.5. Debt in issue is also giving us currently trading at 105 for every $100. Equity beta is given to us, so we know what we will do there. Since we have the equity beta of West, what are we going to do to it? We will ungear it. Once we ungear it, what do we get? The asset beta of West. And they have already given us asset beta of Matravers. Very easy question. This question was tested last year. How will someone in my class get this kind of question in the exam and not destroy it? Okay, anyway. Matravers Co's asset beta of 0.75 is given. So the 0.75 of Matravers weighted against the whatever asset beta of West is, gives you the combined company's asset beta. And when you have the combined company asset beta, the next thing you will be looking for is what? The combined company's capital structure. Because the combined company's capital structure is what you are going to use to regear. So they said the current market value of shares of Matravers is this. I don't even know the number of times they gave us that information. The risk-free rate of return is estimated to be 3.5, and the market risk premium is estimated to be 8. The pre-tax cost of debt of the combined company is this. Can be assumed that the debt to equity ratio of the combined company will be the same as West's current debt to equity ratio. You see, capital structure of the combined company will be the same as that of the acquirer. And we have the acquirer's capital structure already. So we regear. When we regear, what do we get? We get the equity beta of the combined company. You plug that into CAPM. What do you get? KE of the combined company. They've already given us the KD of the combined company. What do? You get the weighted average based on the capital structure to give you your work. Simple, 6 marks, no stress. Now I want to fly. Just watch me as I fly. Okay, so I will put heading. Remember, we said always put your heading. Work of combined company. Work of combined company. Work of combined company. Okay, so I start off with the one I have, Matravers beta assets. And they said Matravers beta asset is 0.75, I believe. Then what I then need is what's the name of that guy? West's beta assets. To get West beta assets, I'll need to calculate the market value of equity of West. I will also need to calculate the market value of debt of West, right? Market value of equity, market value of debt. So what's the market value of equity of West? They have 4,000 million shares in issue, and each one is worth 8.5. So 8.5. That gives me that figure. What's the market value of the debt of West? They have 26,000 million in terms of book value of debt in issue. Each one is trading at 105. per $100. Okay, so that gives me 27,300. Now, since I already have this, then I have my proportions. Is that not true? I've got my proportions. So what is tax rate again? 0.28. So I can calculate what I need straight up here. So watch, remember it's Hungarian. And what's the Hungarian formula? Let me see. I think I can do two things on this Excel. Let me just be sure. Let's hold on a second. Yeah, I can. So remember that's beta asset equals what's the name? Beta A. Yeah, beta asset equals beta equity that I have times, value of equity plus value of debt 1 minus T, okay, divided by value of equity, this equity here. Okay, so that's pretty much what I want to do. So let's make that happen. So that will be equity beta given to us in the question. What's the equity beta? 1.02 times, I open my bracket, value of equity, I pick it from here, plus value of debt, I pick it from here.
Hi, Shay.
Oh, sorry. We are Hungarian, not Hungarian. Sorry, this is wrong. Is that what you wanted to correct?
Yeah.
Okay, should be beta equity times the other way.
Yeah.
Value of equity. Thank you. Value of debt 1 minus T. We are actually Hungarian. So value of equity is all I need there. Close my bracket. Divided by value of equity again plus value of debt times 1 minus 0.28. Yes, okay. All right, so that gives me 0.65. Okay, so now that I have this gentleman, I can now calculate the weighted combined company beta asset, right? Weighted combined company beta asset. So what would that be? They said we should use their equity weights. So before I do that, it may make sense for me to get market value or put down the market value of equity of mattress. Okay, and I think we are given that information. How much is that? Yeah, 12,500. So to effect that, I then calculate and say equals the asset beta of Matra times the equity weight of Matra plus the asset beta of West times the equity weight of West, right? Yes. All of this, not just a part of it, all of it divided by the sum of the equities. Of the equities. By now, you should be very comfortable with weighted average. Okay. Oh, sorry, let me just this. Yeah. Okay. So, any question?
Shay, yeah, this is sorry.
Yes, go ahead.
It's like this question assumes that the market value of master value before and after acquisition remain the same? Because they say the current market value, both under before acquisition and post acquisition.
Yes. So that but wait. Why do you need its value? Where do you need the post acquisition value? You don't need the post acquisition. Okay, so is it because I did this weighted average under combined company?
Yeah.
So that's just used to calculate it. And yes, that may inherently mean that we are making the assumption that its market value post acquisition will remain the same. But remember, Mantra as a single entity will not exist again post acquisition. So really, maybe that's one of the assumptions that will be worth stating. Okay?
Right.
Yeah, 0.6 times. What's this value? Sorry, I have something blocking. 0.65. Sorry, what is it?
I think that's even stated in the question that the debt equity ratio of the combined company will be the same as West Palace School's current debt equity ratio in market values. I'm just trying to answer his question.
Okay. What figure do I need here? 34,000. I don't know. I don't know why I'm doing what I'm doing now, but I'm sure I'm just doing it. 34,000. Okay, just to, make you feel comfortable with the numbers. So now that I've got this guy, what do I need this guy for?
Please, where's 34,000 from?
34,000 is the market value of equity of West.
Not
multiply
14.
the share price. Not what? 14,000.
Yes.
Let me guess how you got your 14,000. I can't possibly guess that.
You have market value of West as equity of West as 14,000.
No, 34,000 is what I have here. And that's 4,000 times 8.5.
Thank you.
Yes, please. Weighted combined company beta equity. So obviously that we regear the asset beta, right? So that's where you use that formula up there. And when you are regearing, okay, so this should be beta equity, this should be beta asset. Ignore what I cancelled. So let's regear. So that will be equal the beta assets that we got times value of equity B on top. Oh, remember, it's going to be based on the capital structure of the combined company. The capital structure of the combined company. And we are told that the capital structure of the combined company will be the same as the capital structure of the acquirer, which is West. So value of equity is there. Value of debt is there. Always remember to take care of taxes. It will not tell you, but it's an important stakeholder. Okay. Yes. Divided by value of equity, which is this. So that gives me 1.06. Okay. 1.06. So the net, what next? KE, weighted, combined company KE. Combined company KE, which obviously is what? CAPM. So that's 3.5 as we are given as the risk-free rate, plus premium is what did it tell us? The premium is 8%. Yes, so 8 times, what is that guy? 1.06. Yeah, So that gives me 12.01. Okay. Then what next? WACC. Combined company WACC. Which is our destination. So as usual, that's also a weighted average, okay, of KE and KD. Remember the question. Yes, go ahead with your question.
Sorry, can you just go back to the weighted combined company beta equity?
Yes, it is there. So while you're looking at it, they told us that the pre-tax, take note, cost of debt is pre-tax, which is 9.8. Okay, so I guess I can move on. 9.8. So my WACC would then therefore be KE multiplied by the weight, okay, plus KD multiplied by the weight of debt multiplied by, into bracket again, 1 minus 0.28. Generally, I advise that you should not try to merge too many things in a formula so that you don't make mistakes, unless you're so used to what you want to do. Okay? So all divided by the sum of these two. So we have 9.8% as our WACC. Any question? Looks like there's no question. Okay.
Hello?
Yes.
Yeah, hi, Shay. Sorry, please, I have a question. Yeah, so, our question, the question said that the debt to equity is the same as the acquirer's debt to equity. I just need to confirm if, this is the usual way of doing this, because I've seen a question where, that wasn't stated, and what they've then done is to add the equity of both companies, right, in solving it.
Let me answer your question, okay? But that last statement you made, I'm not sure I understand what you mean by that. Yes, in this question, they said, this is what they are saying. The capital structure that West, the acquirer, has now will not change after it has acquired, what's the name? Matravers. Now, that will usually make sense in practice where the company you are acquiring is of a smaller size. If, for example, Apple, with a market valuation close to about 2 trillion, or if not more, says they want to buy GT Bank, okay, with a valuation of maybe close to $1 billion. Whatever the capital structure of GT Bank is, whether it's 90% debt or 10% equity, by the time they bring GT Bank into the Apple family, it will have no impact on the capital structure of Apple because it's a much bigger company. Do you understand? So sometimes it's okay to make those assumptions, particularly where the acquirer is much more bigger than the target. It won't change our capital structure. But if mates are merging, or one is acquiring the other and they are roughly equal size. So for example, if Ivy League wants to acquire Oxford University and roughly equal size, yes, then why am I saying If Oxford has a capital structure of 50-50 and Ivy League has a capital structure of 70-30, it may be the case that post-acquisition, the capital structure of 70-30 will change to another thing. Maybe, for example, 65-45 or 60-40. So, but if the question says maintain the capital structure, that means they're telling you financial risk will not change. But as you can see from the question, the business risk is going to change. The business risk will change because the business risk of Matravers is currently 0.75. But the business risk of the other man, West, is 0.65. You can see that the operating risk is not the same. West has a lower operating risk. So as a result, they are now saying if they combine, West will not be able to maintain that operating risk of 0.65. So the new combined company beta asset is now 0.67. You can see that it has shifted, but only slightly because of the relative size of Matravers. Okay, so I hope I answered your question.
Okay, yeah, I get you. So so in the case where the financial risk has then changed, right? How do we arrive at what the capital structure should be for the combined company?
Okay, so if they are telling you that there will be a new capital structure, they will tell you that capital structure or give you information for you to calculate it. Do you understand? So it's either the business risk is changing or financial risk is changing, which is type 1 acquisition. But if the two of them are type 2 acquisition rather, if the two of them are changing, both business risk and financial risk, which is type 3 acquisition, though we can solve it theoretically, that answer will not be correct. We can prove that the answer will not be correct for some reasons. If you want to know those reasons, go and check the question we solved in class called Pursuit and Voda. Inside that question, Pursuit and Voda, the examiner made the same assumption here that candidates should assume that capital structure of the acquirer will remain unchanged. They will be the same as the combined company. But business risk change, we had to calculate asset beta and all of that. In another part of that same question, they now said we should confirm, we should assess and confirm whether truly the acquirer can maintain that its capital structure. When we did the test, we found that it cannot maintain its capital structure. Now, because it cannot maintain its capital structure, it means both financial risk and business risk will change. And if that is the case, the only thing that can solve that kind of scenario, the appropriate way in real life, is a spreadsheet through simulation, because you have to ensure that any internal inconsistency in the capital structures that you have used to calculate your asset beta, repaired, to calculate your work of combined company is consistent with the overall allocation of that capital for the combined business. So bottom line, to answer your question straight and direct, if the examiner wants the capital structure to be different from that of the acquirer, they will give you the information to calculate it. But by the time you get your answer, it is only because of the assumptions that you have made that will make the answer correct. Because in real life, you can't solve that kind of scenario just using the models we are using currently. Okay? All right. Any other question?
So, yeah, can you put your cursor, please, on the combined cost of the cost of equity, please? The 12.01. I just want to see.
Yes. Yes.
Okay.
Yes. There.
21. Okay. Thank you.
Okay. Good. So now I move on to the next part of the question. And the next part, yes.
Please, the KE I calculated, I got 11.98.
Yeah, I got 9. That's That's why I'm wondering why it's different.
The what? The KE you calculated?
For the combined companies, I had 3.5 plus 8 times 1.06.
Okay, maybe approximately because of the computer has some other decimal places we're not picking. I'm not sure what is going on. I have 11.9.
Yeah. This figure is probably I don't know whether did you use 1.1 or something. So it's probably 6.4 something 6.3.
Maybe
You see that? Yeah. So that's just it. So it's picking the full number, but you just pick 1.06 straight up. That's what would have happened. All right, let's move on. That's not having any material impact on your score or anything. Now, the next part of the question says we should calculate. Wait. Some hands are up. Brand. Do you have a question? Noya, do you have a question?
Yes, I do. The combined work. Can you just put your cursor there? I'm getting something different.
Combined work. Yes, this is it.
15
Noya, what's your question? Noya is not asking now. All right, maybe she doesn't have any intention of asking any question. All right, so I'll just move on. The requirement says estimate the total value which West shareholders will gain from the acquisition of Matravers. Now, once you see a question like this, you know that you need to decide on your decision criteria. So can somebody tell me, if you were in the exam hall, what would be your decision criteria here? I'm sure you know what I mean by decision criteria, based on the review we did earlier.
Hello?
Sorry, what's the question?
My question is, what's your decision criteria for V3?
I think it will be value of combined company minus open brackets value of what's it called, West Pali reacquisition plus value of Matravac plus the part they want to sell, then plus premium. We deduct all of those from the value of combined company.
Okay, I'm sure you may have to come back again. I didn't get what you said.
Okay, I think I want to adjust it.
You better do.
I forgot they
again.
sold a part of it before. So what I think it will be is value of combined company plus the sales proceed from the tech, Matravac tech that will be sold. Then minus open brackets value of West Pali before acquisition plus value of Matravac, the remaining part of Matravac that they want to combine, then plus the premium they intend to pay. I don't know if I'm correct.
This is a powerful decision criteria. Yes, who else has? I think I'll be writing subsequent ones down now so that before you guys lose me, I would have gotten myself back. So who else has? What will be your own decision criteria? Bilkis, I got what you said, so that's fine. I will however, you will however see what it's like once we're done. Yeah, who else wants to try? Samuel, go ahead. Yes.
So sorry, I'm not good with the name, so but I'll just use acquirer and the acquiree for the sake of this analysis.
Fine. Make sure you tell the examiner that too.
No, I'll just copy the name in the exam and paste. Right. So I think the issue is really on the left-hand side. So let me even start with the right-hand side, which is the value of the separate entities pre-acquisition, right? That would be the value of the acquirer, which is West Pali, plus the value of the acquiree, and then plus, of course, the premium. That is the right-hand side. Now, on the left-hand side, the items we would have there would be the combined sales revenue of the two entities combined, plus the sales value, plus the proceed from the sale of the acquiree, which is Matravite, plus the gain, if you like, from the reorganization of the acquiree's remaining business. So I think that's what I see in this question.
Okay. Thank you, Samuel. Samuel, but I want you to go back again on the right side.
Okay.
The first side you talked about. Yeah.
Okay, so I talked about the value of the acquirer pre-acquisition, plus the value of the acquiree, plus premium.
Okay. So I've heard what you said. Thank you. So in fact, wait. Don't go yet. Let me write it down. What you are saying is you compare value of combined company, which is acquirer plus the part of Matravas that they will combine. Just be confirming as I'm writing. Is that correct? Plus, you said that one plus sales proceeds from selling the tech business plus value of what they call synergy from reorganization. Okay, value from reorganization. Okay, you now said all of this, you compare it to what?
Pre-acquisition of the acquirer, pre-acquisition value of the acquiree.
Value of the acquirer plus value of the target plus premium. Abi?
Yes.
Okay. Any other attempts from any other person?
Yes. Hi, Shay.
Hi.
Yes. We'll have value of the combined company.
When you say combined company, what do you mean?
That's the value of Wesley and Wesley shareholders plus the sales proceeds minus, so that's the one hand, then minus the current market value of Matavas plus the loan, the long-term loan that Matavas
plus the long-term loan, Abi. Okay.
Yes.
Plus the value of loan.
Yeah. Then plus 15% premium.
Premium. Okay. Powerful. Okay, now. Thank you. I heard you. I heard you clearly. But the question is, Samuel needs to come back and come and answer another query. Samuel, are you there? This your value of target. Is it equity value of target?
So let me come back again. Can you ask your question again? Let me hear you clearly.
That value of target that I wrote down on the right side, just look at my screen. The value of target, is it equity value or total value of targets?
Let me confirm the discount rate we have to know what is coming in there.
Hey, believe me. Okay, go and confirm. Go and confirm. Go and confirm. Any other suggestion? You remember I normally tell you guys, if there is no, now this your hand is oh, you wanted to say something? Okay, because I've been calling your name. What's up? Oh yeah, go ahead.
So okay, so I was thinking maybe we would have the value of the combined companies, then plus the gain we'll make from the sale that we had calculated before, and then plus synergies, then it should be greater than the value as at the value of the acquiring company, and then the value of the target company and the premium.
Okay, wait. No, yeah, I want to ask you a question. When you say gain, you are saying not the sales proceeds, but the gain of 500 and something that we got up there. Is that what you're saying?
Yes.
Okay. Now, this after gain, you said I should add synergy. Do you mean value from reorganization? Is that what you mean?
Yes, the last part of the question.
Okay. Value from savings, cost savings, as they said, or reorganization. Then you now said on the other side we should have value of what?
Of the acquiring company.
Acquiring company.
The value of the acquired company. And then the premium that we'll pay extra.
Okay, now yeah, another question for you. This value of the target company, total value or equity value?
Should be the total value.
Total value. Okay, so the business value. All right. Okay, thank you, Noe.
Sorry,
now, yes.
Yeah, okay, so I wanted to say that in my formula that has the value of the combined company, the synergy was included in arriving at this value. Just wanted to put it out there.
The synergy was included in arriving at which value? Your own formula is the second one now?
Yes, the firm value for the combined company.
Oh, okay, you put that synergy here too.
Yes,
okay.
Yeah.
Now, Chineye, wait, before you go, because this your own formulation is very implicating. Now, I have a question for you. What is your definition of value of combined company? What is contained there in value of what, and what?
So this is, oh, okay. So what we have, that's going to be the free cash flow to firm that counted at the discount at the WACC.
No. I'm not talking of valuation methodology. I'm saying that VCC.
Yeah.
Value of what is in it? What are you combining there? Because you seem to be combining a lot of things.
I'm confused.
You are confused. Okay, let me ask you. When you say value of combined company, do you mean the value of West together with the parts of Matravers that they merged, together with the synergy from that merger?
Yeah, so you know where they have the post-acquisition details where that estimated how sales revenue will grow. Yeah. So that like based on the information there.
Okay, based on the information there, you still not answered my question. You are throwing me up and down.
Wahala.
And there's a reason why you need to answer that question, because your answer may be the only correct answer here, or it may also be part of the wrong answers. That's why I need to know.
Okay, so what exactly
do I want?
Yeah.
Okay, this is what I'm asking. And I'm sure
Okay.
everybody understands what I'm saying. For example, if I ask Samuel now that, Samuel, what's in your VCC? Samuel will gladly tell me it's the value of the acquirer, which is on a post-acquisition basis, the value of the acquirer, together with the portion of Mantra that is merged, which is their out-of-town stores and the city center stores that they did not close, you know. So it will tell me that that's what it means by his VCC. But obviously, you are saying your VCC includes this value of reorganization, which is the synergy, whatever. But I'm now saying, in addition to that, what's in your VCC?
Oh, okay. So apart from that, so it's also the value of the acquirer. No, not the acquirer. The value of the post acquisition. That's the Matravas home stores.
Post acquisition. Okay, so you don't want value of Westra here. That's what you're saying.
Value of Westra. That's value of
value of Westra post acquisition together with value of Matravas home. Is that what you have here, or just value of Matravas home post acquisition?
No, I have value of both.
Both. Okay. So that means what you have here is value of Westra plus value of Matravas home post acquisition, right?
No, so value of West Pass is not. There's just the value of Matravas after post acquisition and the synergy. That's just what was there. Yeah.
Fantastic. Why?
That's just what's there.
Okay, wait. Why? Why?
Because both at the value, the information that was given to us here. Because actually, the reason why it's like that is because the synergy already incorporates what Westpally will be bringing to what their acquisition is going to bring forth. So that's already like a function of both of them. I don't know if that makes sense. I don't know how to explain.
No, the thing you wanted to say before, can you say that one?
Oh, because I wanted to say that because you are trying to get the gain.
You're saying something about information, that the information.
Oh, okay. Yeah, I was saying that because the information they gave us is information with regards to Matravas homes, in terms of like what happens.
Fantastic. That's enough. That's enough. If you say any other thing beyond that, you will scatter it again. See, the only person that is somewhat correct is Chineye. Okay. And as you can see, Chineye did not put anything about Matravas here. And I'm sure in the exam hall, a lot of people will make that mistake again. This is wrong, this is wrong. And every other person that is thinking they will put the value of the acquirer somewhere there, which is value of West. This question is similar to what we did under Signo or Kigno, whatever you decide. That question called this, if you remember. Similar. They intentionally, that's why question practice is good, though. And that's why you have to be asking yourself, what did I learn from this question that may be useful somewhere else? They intentionally, in that question, only gave them post-acquisition information for the subsidiary or the entity that is acquired, the target. Look at this same scenario as well. Oh yeah, everybody, go to post-acquisition information. That's the deal breaker here. Once you miss it, then the answer can't be correct. Post-acquisition detail. Once Matravas Tech has been sold, Westpally Co. estimates that the sales revenue from Matravas home stores, which remain open, together with online sales from its home business, all of it relating to Matravas, will be 43. This 43, 260 million, is not West plus Matravas home. it is only Matravers own. So your valuation should have nothing to do with West. Yeah, I don't understand what you have said. Can you indicate? Shino, I'm sure you go. Shino, do you have a question?
Actually, you know, when they were giving the options, because I was looking for the value of West Pali, I didn't see it. So I knew that we may likely not use value of West Pali. So from what you're saying now, the model we use will determine the information available.
The information available will determine the model you will use.
Sorry, yes.
And then the information available will determine your decision criteria. Remember, that is what I taught you in the early part of today's class when I was talking about decision criteria. Look out for the information given to you because it will determine what you will compare with what. I agree that the best answer here in an ideal scenario is the answer provided by Samuel. Just to have space, let me scroll properly so that you understand what I'm saying. Samuel said, for those that didn't understand what I said before, Samuel said, value of combined company, his mindset is this will be West together with Matravers Homes, okay, that they will be combining together, right? Since they would have sold tech, plus sales proceeds from tech, which makes sense, plus value of savings, cost savings, reorganization, blah blah blah. This is what he said. He now said minus value of acquirer. Now it is okay to put value of acquirer. Remember, acquirer is West. Let me just be consistent. West. It's okay to put value of West here plus value of Matravers as a whole, as it is currently, plus premium. So it is okay to put value of West here. Why? Because on this side as well, West is there in his own formula. So this would have been okay. But the only problem with this is he can never get this information because it is not provided. So if at all he did not pay attention to the fact that they didn't provide the information about West post-acquisition, he would have just done the valuation based on the information they provided in post-acquisition value, but those values will be significantly underestimated because he will be putting the total value of West here. But then Shino is even telling us that they didn't even give us the value of West. Are you sure that's not provided at all in the question? Well, post-acquisition, yes, I don't think they, post-acquisition, no. It's just pre-acquisition they gave. So pre-acquisition, Samuel would have been able to get it because it will be in the question. Is that not true? But post-acquisition, he would have used the wrong information. I'm just picking out Samuel because, he was the good student that spoke. Now, what is Chinaya saying? Even though I'm not too very happy with the fact that she's putting the value of that savings inside the combined company, okay? And maybe we should not be calling it combined company because the word combined company may be misleading. She is saying value of Matravers home post-acquisition. You see that? You see I've changed the name. Plus sales proceeds of Matravers. Of course, that's tech. Plus the savings that they will get because they are going to be able to cut cost as a result of acquiring Matravers. Less, she did not put West on the other side. She only said value of Matravers as it is plus premium. This is the answer. So if this one is still not clear, then ask your question or see me after the class. Duni, your hand is still up. Hello? Do you have a question or? Okay, it's down now. John, go ahead.
Yes, I just wanted to confirm if value of Matravers, which we are taking out, if it's The total value, or if it's just equity value.
Okay, yes. So that one will be the total value, because the value we are getting on the left side will be free cash flow to firm valuation using the WACC that we got. So you understand? And obviously that will give you total value. And do you get that?
Yeah, I get that.
Okay, good. It looks like we're all on the same page now. I don't see any hand up. All right, so let me do it, and then if you've got questions, you can ask later. But that's really the trick in this question. You have to pay attention to the information given and what they did not give you, okay, so that you only work with what you need. Now I need to take some of these things off. All right, so gain to this, so I will say the first thing I want to do is to determine the value of matravers. I will need to take this entire thing off. No, this will waste my time. Let me see, this will waste my time. You know what will happen? Maybe I'll just, oh, sorry, I can, sometimes you just forget that you are, yeah, okay. So value of matravers post acquisition. Value of matra post acquisition. So value of matra post acquisition will be number one, free cash using free cash flow to firm valuation. Okay, because obviously the information they gave us requires that we use free cash flow to firm. Now, one of the things I told you guys earlier is once you determine the valuation method you are to use, and that valuation method requires the use of a cash flow based model, I said, what's the next question you will ask yourself? You said you will ask whether it is constant growth rate, no growth rate, or multi-stage growth rate. Can somebody answer which one applies here?
Multi-stage.
Multi-stage, good. Multi-stage, okay, because we are told that, where is that guy again? We are told that, yeah, so for the first, sorry, blah, 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 in the first year, and this figure is expected to grow by 3% per year in year 2 to 4. They now said after 4 years, the annual growth rate of free cash flow is expected to be 2% for the foreseeable future. So that means we have to deal with multi-stage. So I've got to put my years together, years. So that is year 1, year 2, year 3, and year 4. Okay, so if my figures are to the nearest 1,000 million, then I can go ahead and say what my sales will be for year 1. So they've given us the figure already. They said that's 43,260. So I then need to start growing that based on the growth rate of 3% that we are given. So can you, oh no, you don't need to help me. Sorry, I forgot. I'm almost used to that style of okay, yeah, so we're good. Sorry, just make good of this one. Okay, good. So that's our sales revenue, and then after that we can get what? PBIT, profit before interest and tax. What's the margin they say applies? They said profit before interest and tax is expected at 6% of sales revenue. Affects this year, so 6%. So 6%. So that means I can then do 6% of the revenue. But remember to lock this. So that gives us this figure. And then we are told tax rate is 28%. So you deduct tax. Remember, what's the formula again for free cash flow to firm? Let me not make what's the name? Assumptions. I can just quickly write that here. Free cash flow to firm equals PBIT minus tax plus non-cash items. So plus or minus non-cash items anyway, but usually that would be TAD. You add back TAD minus investment in assets and investment in working capital, which is capital that is working. Okay, now investment in assets are of two types. Can somebody remind me what are the two types of investment in assets? What are the two types of investments in assets?
Okay, the two types of investment assets is one investment that is required to maintain current level of production and investment that's used for expansion.
Very good, very good. So I specifically asked that question because I think they told us something in the question that will make us need that. So, but by the way, let's charge our taxes. So that will be negative this amount logged times our PBIT. So that gives us these values. Okay. Now the next thing is then we need to, normally we would have added back TAD because TAD would have already been deducted in arriving at PBIT. So normally we should add back TAD, but the examiner says, the examiner told us, he told us that tax allowable depreciation is assumed to be equivalent to the amount of investment needed to maintain existing operations. So that is the first type of investment in assets, the ones required to replace assets that are diminishing in value, okay, so as to maintain current capacity. So that would be the same thing as TAD. So what that statement means is that if I come here now and I say TAD, add back, of which I don't even know the figure self, okay, then I must also come here to say investment for capacity maintenance, okay, capacity maintenance. I will come here as well and say negative X, okay, sorry, in bracket X, and I'll replicate that same thing here as well. Okay, at the end of the day, what's the net impact? 0. So once they give you that statement, it means you don't need to add back TAD. You don't need to add back TAD. But we need to take care of the second type of investment, which Emmanuel told us is the investment required to increase capacity. Since this company wants to be growing at 3% now and 2% in perpetuity, they have to grow their capacity. And to grow their capacity, the examiner says, however, an investment in assets, including working capital, will be required of $630 million in year 1. In year 2 to 4, investment in assets in each year will be 50% of every $1 increase in sales revenue. So we go there and we deal with that. We call that additional investment in assets. Okay, so year 1 we are already given the figure, that's almost 630. Then year 2 they said CO, they said 50%, which is 0.5, okay, of every increase in revenue. So you get the increase in revenue, this minus this, that gives me a figure. Okay, good. So we do the same thing for the other ones and test that is consistent. Okay, yeah, no question. Good. Next, I move on And then I ask myself, what's the next thing I need to deduct? Working capital. Did it tell me anything about working capital in this question? No. So that's all. And then move on to get my, what's the name? My free cash flow to firm for each of the years. So FCF will then be, oh, sorry, what did I do there? Sorry, FCF will then be. Now, please here, be careful not to go and bring your sales revenue again, which would have just been an error. That's why I left a gap there so that I won't make that mistake, okay? So I then drag this to the end. All right. Now, the next thing is to discount this cash flows. But for us, before we discount this cash flow, we normally like to bring in our terminal value. The terminal value is the present value of all the cash flows you will generate from the point that growth rate becomes constant in perpetuity. So tell me, how do I get my terminal value? I will put it under year 4 because I'm discounting from year 5 to perpetuity back to the beginning of year 5. Beginning of year 5 is the same thing as end of year 4. So what do? I pick my final free cash flow, which is what I want to grow, at what rate? 2%, 1.02, okay? And then I divide that by WACC minus G. WACC minus G. I'm sure everybody here knows that formula. If you don't know the formula that I'm applying now, see me after the class. You need special attention. 9.8 minus 0. No, wait, that's 2. Problem is I did not say, okay, 9.8 is that in Abi, so let me write it in decimals, and that's because I didn't use percentage there. I just observed now that I didn't state the values in percentage, so you have to be careful. See, that's why practice is good, so you don't make unnecessary or avoidable mistakes. 0.02. Well, maybe I hope that's fine. Yes, so we've got this figure that looks like a figure. All right, so what next? The next thing certainly is to then bring everything together, right? So equals sum of this to this. So I bring everything together, yeah, and then this way I can then discount. So discount at 9.8%, right? 9.8%. So I can put the 9.8% here so that I can use it as my discount factor. That will be this times 1 plus, fix this guy, okay, raised to power, where are you, gentlemen? Raised to power minus number of years up here, which is 1. Okay, does that make sense? I think it does. Yeah, so that gives me 1128, and I guess I can drag to get the other years. So that's this figure at that rate, by that rate. Okay, good. Looks like we're fine. So that means the value of what's the name now? The value of Matravers on combination with on acquisition or post-acquisition value, okay, or let's say valuation based on post-acquisition will be the addition of everything. Okay, so that's 16 to 90. Any question? Any question? No question. All right.
Sorry,
yes.
So when you were actually making those that constant figure absolute, I noticed you use the shortcut, but I've noticed that on the test switch, you have to be inserting the dollar in manually. I don't know. Is it that because it's on practice? Is it, can we have such shortcut on the live?
What shortcut? Where?
If I want to make, for example, that 9.8% constant before I can drag.
Oh yeah, okay. So that you may have to be doing each year one by one. Is that what you mean?
Mm. But otherwise, another option is for us to now begin to put the dollar in front and dollar at the back to make it constant rather than doing it fast.
Okay, is that what you did on test straight? You
Yes.
couldn't get the shortcut to to just press a button and put it there. Oh, okay. Okay, maybe that's what it is then. But that's not really a lot now. Just put the dollar. It's just once you are doing it, right? And then you drag.
No, if you are putting the dollar, you put the dollar before the two columns and the rows, then before you can drag. Though it doesn't take time anyway, but it will be faster with short.
Yeah, I'm saying it's just only in that first cell that you will do that. And then you drag the remaining, yeah. So it's okay. 16 to 90. Yeah, 16 to 90. 16 to 90. Okay, so what's the next thing? The next thing I need now is this value of synergies that we said would arise from the acquisition. So that one is for 3 years. 1, 2, 3. Okay. And then they said it is free cash flow already given, FCF. Year 1 is 700, year 2 is 750, and year 3 is 780. These figures are really progressive. Okay, then we need to discount that as well to get a present value. And again, we are discounting using the same post-acquisition WACC. So I'll take that up a bit, and then I would say PV discounted PV discounting at 9.8%. Okay, so that's this figure times 1 plus this. So what he was saying is you come here, put dollar, come here, put dollar. Okay, that's fine if you have to do that, and then raised to power minus number of years. Okay, so that gives that, then you can drag. All right, so sum. Total value of synergies then becomes what? Sum of everything. 1849. 1849. All right, so how much do we have to? So we've done what we need on the left side. Okay, we've done what we need on the left side. Remember, we already have the sales proceeds. So now it's time to move to the right side. And on the right side, we only need two things: the value of mantra, our mantra verse, and the value of the premium that is to be paid. Okay, so amounts, let's say equity value to be paid, or maybe let me just do it one by one. Market value of equity of Matra. We have that figure already, is that not true? I think it's 12,500. Then debt value, market value of debt, they said is equivalent to this thing. How much is that one? 6.5 or so. Then we then have, what's the name of the other guy? Premium, right? Premium will be what? 15% of equity value. You don't pay premium on total value, don't forget that. So total, and this total is the total amount that you are comparing to post-acquisition. If Matravers is bought, we pay a premium, and if you have to pay for the debt and equity, this is the total amount, 2875. 2875. So benefits, which is what we are looking for, benefits, overall benefit, I think I like that, overall benefits of the acquisition will be what? See what I'm picking up. See you. First, I go for this total value that I already have, 16,290. Next, I go for sales proceeds. That must be somewhere up here. Total sales proceeds is 5054. Don't pick 554. 554 is just excess value they think they will create if they decide to sell. It's the sales process that is the total cash flow that will come to them. 5054 plus a synergy savings arising from reorganization that will take place, right? Good. Minus the right side. That gives us net benefits of 2,318 million dollars. This is fantastically fantastic.
Please,
I am done with that part of the question. What did you say I should do?
Can you please repeat overall benefits?
I should repeat overall benefits. Okay.
Please.
Overall benefit is number 1. So following, let me go and bring that thing that I wrote down here so that it will be very clear. Yes, this definition here. Let me drag it to this side. Okay. I'm coming on. Yeah. Good. So that's what we've done here. Value of Mantra Home post acquisition, which is the 16 whatever we got. Sales proceeds from selling tech, which is 5054. Value of the synergy savings or reorganization savings, which is 1849, minus value of Mantra, which is its debt and equity, plus the premium we have to pay. That is what I have there. So, madam, is that fine?
Yes, thank you.
Okay, any other question? No other question. Okay.
Sorry, Shay, a little clarification. When we calculated the post-acquisition value of Mantras, right? We used the WACC, right? And we had a total market value of the entity, right?
We used the WACC. Yes.
I was hoping that we are going to back out the cost, the value of debt to get equity value, just equity value. I don't know. Maybe you can just clarify that bit for me. I'm not sure I understand why we did not back out debt, or is it the same thing we are getting if we had used equity, cost of equity to discount, or I don't know. I think I'm just missing.
Okay, so let me answer that question. It's a function of comparing apples with apples and not comparing watermelon with apples. Okay, if on the left side you are getting equity value, then on the right side you must also get equity values, right? Now, question is, can we really get equity values on the left side? Two approaches. One is to use free cash flow to equity valuation, which means your free cash flow that you have computed will be different from what you have here. You would have to have deducted interest and the tax benefit of that interest. We are not giving that information post-acquisition. Okay? But beyond that, the other method is to say, okay, the valuation we have of 16 something, can't we deduct the value of debt from that, the market value of debt? I think the problem I have is they did not tell us what the post-acquisition value of debt of Mantra will be. Or did you see it anywhere? Okay, so it may be dangerous to assume that it will remain 6.5, because remember that 6.5 was used to fund the entire business. Tech has been disposed. Market value of debt may change for Mantra post-acquisition. So since I can do total firm value on both sides, I just find it more convenient to do that. Did I answer your question?
Yeah, that's fine. Thanks. Thank you.
All right, let's go back to discussion, which is the more interesting side. So let's get back to our writing mode. Just a minute. By 5:30 we go on another short break, and then when we come back we will finish this question and probably take one more if energy permits. Where are you, Westpally? Here's my PowerPoint. Okay, so please read the requirements of the final part of the question. Actually, not final part. It says Sorry, just a moment. No. I don't like using. Okay, no problem. So it says assess the strategic financial value to West Pale Coal of the acquisition, including a discussion of the estimates and assumptions made. Assess the strategic and financial value to West Pale Coal of the acquisition. What's the strategic and financial value? Okay, including a discussion of the estimates and assumptions made. So how would I structure that place to ensure I earn the 12 marks? And also the 4 marks that relates to report. So you should really be viewing this question as 16 marks. Number 1, I have to remember that this is where my report starts. So the to, the from, the date, the subject, you put that up. And then you also put an introduction paragraph where you would say, in summary, the things that you want to talk about. Okay? Then, strategic and financial value. I can decide to talk about the strategic value and then decide to talk about the financial value as another heading. Then the third heading will be the estimates and assumptions made. So whichever one you want to talk about, the floor is sincerely yours. Just go ahead and talk to me. Yes, I agree. You need to take time to think. That's what we agreed today. So you sit back, you think, you build your points. So maybe you should even take 5 minutes to do that. Build your points. What are the key things that I need to discuss? This is where you need to sit back and say, okay, I've done all the calculation, I've read the scenario. What are the key things that I need to discuss at this point? So anytime you're ready, I'm ready.
Hello, Shay.
Yes.
Okay, so I'm reading in I think the second, no, second part where it said Mabatraku and the financial value to Wesley can be
It's like you are using two devices.
No, one.
No, we can hear him clearly. Go ahead.
Okay, so I say okay, if financial value to Wesley Co or West Padley Co is that since here they said the where's the line said someone line said okay blah 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 one major competitor of Babatrack Homes has just gone out of business, and since that gets out of business there is room for more market domination. So the fact that West Palico has the financial capacity, it can bring in funds to Matraco and dominate the market to show that okay, it actually gets the increase in revenue that was estimated in the computation of the value of the business. So that's one financial benefit. So an increase in market share. Yeah. And yeah, that's my concept.
Okay, thank you.
Another benefit it would get from acquiring Matravac is that is financial synergy. So in the sense that he can, of course, when he acquires it, the balance sheet becomes bigger and it will be able to get more funds from fund providers. Then it can also have access to Matraco's cash. So that's another financial synergy that can come from it. Then it could also have access to the skills of the staff of Matravac. That would help it, produce more, better product, and since they now have more cash, then they can produce better products. Then it can also lead to economies of scale, buying goods at cheaper cost. Since they are in the same line of business, they can buy raw materials, you can buy in bulk, and that would lead to cheaper cost and more profit for them. Then it could also make it have more competitive power, competitive edge. Since they said some businesses in that line, some businesses in that same line of business have been closing down. So now it's merging with another business, can make it bigger and have more competitive edge above those that are still remaining in the business.
Okay, thank you. I have a few concerns around some points though, and I'll tell you. So for example, I'm not sure they are exactly in the same line of business, right? So while there may be some complementary synergies, I don't necessarily think it will be economies of scale. I think it will probably be more of economies of scope. Okay, so an economies of scope will manifest in the area of all those out of town stores where they plan to be selling both their own products and the own products of Matravers. Next brand, go ahead.
They told us, hello, they
Hi, how are
told us
you?
they both sell
Can you hear
household
me?
products.
Can
So
you?
I want
Yes,
to ask.
we can hear you.
Okay.
Hello, Shimi.
Hello?
Brad, go ahead. Bilkis, hold on, please.
Yes. I think on signages in terms of administrative, yeah, there could be that is right in terms of the scope, like you said, because there could be saving from the shared services like IT, for instance, finance and all that. But operationally, yes, I see it a little bit a challenge as well, because they are in different line of businesses. So they cannot be in a way of saving that. But also, I think contrary to this, because they have not really showed as to how we can't really see the calculations of these signages. It's more like still kind of assumptions, but you need to be able to put the value or the figure to how these signages would come up in terms of revenue and the other signages. That is, I think, how I see it.
Right. Thank you very much. Very good points. I particularly like the point around the operational synergies may really not be realized because they are not necessarily in the same line of business. Jane, you may want to take care of your video. Okay. So yeah. Then you also talked about I lost my thoughts in that area. Okay, so yeah, administrative savings. I think you mentioned that may happen. So for example, if they currently have a receptionist in a store, they probably don't need to still retain the receptionist that will be coming from Matra, right? Or if they shut some of the city center stores, then they probably will not be carrying forward some of those costs. But operational wise, you also have to check, which is really what is related to what I was talking to Bill Case about earlier on. Economies of scale, I don't think that will be a lot. It's probably going to be really more of economies of scope. So that then talks to the issue of synergies. Can they really realize the synergies that they have there? You will notice I said something when we were doing the calculation that those free cash flows they envisage from the synergies are growing year on year up to year 3. So question
I also
is
mentioned that another challenge I think would be on attaching value to if you look at this question, to how we're going to calculate the synergies as well. It's so good to see, yes, there is revenue, there's synergies here and there, but if you cannot attach value to that, I think it will be difficult trying to see the real value which has been realized from that. I think that is another area, because I think in certain questions you'll see that there will be more pointers trying to see, so that when you have to put the two areas together, you should be able to get direction as to what value as this area added in terms of what we're trying to achieve.
Yeah. All right. Yes. So quantifying some synergies may also be theoretically possible, but in practice, it may actually be thought. Maybe let's put it as being very subjective. So because these are based on decisions they want to make, not decisions they've made. So estimating what the cost savings might be or the revenue synergies that may come from potential actions you want to take may actually be a subjective process that may not end up being realized. The other side of it that you may also want to consider, still related to the realization of these synergies, is actually related costs, because you just don't think of laying off people, shutting down some facilities, using using shared services and all those things without the implications that may arise. So for example, to lay off people, you may have to consider redundancy costs and severance packages that you would have to pay them. It's not so straightforward to shut stores, particularly stores where you have non-cancelable lease arrangements, and you may have to start paying breakup fees for breaking the lease prior to the end of its term, and then obviously also staff integration. So there may be issues around culture, which may, not make those synergies that you had anticipated to eventually become realized. All right, so that's a good one on the synergy side. Let's not forget the most basic one, which is to tell the examiner your financial results. Okay, we've got to tell the examiner our financial results. So we have to tell the examiner that, okay, if they decide to sell this, it is expected that they will make 500 and whatever. But more importantly, the overall benefit of this synergy to West shareholders is estimated to be $2,000 and something million based on what we calculated. And obviously, you state that that is with some assumptions that underlie the calculation that you have done. Now, I don't want us to deviate from something, though I agree with taking one strategic part of this question, which is the synergies, the realization of synergies. But the decision on what they want to sell versus what they want to retain, and even within what they want to retain, the one they want to close and the one they want to merge, do you think strategically it works well? Where do you have issues? Where are you fine? That's really what I want us to address. John, let me hear you.
Yeah, hi, Shay. So yeah, following from what you've just said, because like they've said, they're going to retain some shops where Matravers will be selling their products, right? And those shops are expected to make a profit, right? So, and I mean, from the introduction, we've seen that, part of why they are doing so well is because they have a strong online presence. So their estimation as making a profit from selling in stores where Matravers, from stores that will be retaining from Matravers, needs to be looked at to assess whether or not that is an overestimation of a synergy. And it also looks like they're deviating from a strategic point of view of improving their online presence and maximizing profit from that.
Okay, thank you. Bilkis, you want to say something?
I just want to ask about the realization of the synergies you talked about. That do we have to mention those ones too? That the ability to realize those synergies, or things that could make them not realize it. Do we have to talk about those ones too?
Yeah, and we have actually. We've talked about that already, and the things that may not make them realize it. Hyan, go ahead, please. You're not talking. Emmanuel, go ahead.
Okay. I was looking at the.
I was just saying that I was looking.
Okay, Emmanuel, hold on, please. Go ahead.
Okay. Now I was saying that from the point of view that they want to go into online sales, I thought maybe there might actually be a kind of a mismatch in the sense that they're actually disposing something that actually has got to do with Meta Tech, which I thought maybe if at all they maintained it, them actually going into online selling might be actually some kind of an advantage if at all they retain some of their the prowess that they might actually have benefited if at all they really kept Matra Tech or something.
Okay, I like that, but careful. Let's look at what Matravers Tech does. It says Matravers Tech sells computers and mobile phones in much smaller outlets than Matravers own. So Matravers Tech is not really a technology-empowered business. It is just selling computers and mobile phones in retail outlets, not online. Not that they have a lot of, prowess in the area of online capabilities. Do you get my point?
Yes, I do get it. Yes, I do get what you're saying. But I was just thinking that if at all they're actually selling, wouldn't actually sort of maybe would you not be likely to sort of maybe associate it with some people as part of their staff who have actually got knowledge to do with what happens with online? I think maybe that might actually be too much of a far-fetched what should I say? Maybe linking. But I thought maybe there might actually be some things that they might actually sort of maybe harvest from having maybe people that I didn't know about a bit about technology from the things that I know to do with technology. But I mean, it might be far.
Yeah. Right? Yeah, the point is fine, but I'm just trying to ensure it's okay in the context of the scenario. So remember that West already has online presence and it's aiming to invest more. So it's not really naive in online business, right? Matravers, the tech there is just because they are selling mobile phones and computers. Now, maybe they may have some staff that are tech inclined. Now, it's okay for you to mention that they may take a review of Matravers tech and identify some staff that may have, knowledge of online sales, online security, IT security, and all of that they may consider retaining, as part of, boosting their, their online business, rather than having to recruit such individuals afresh from the market. So that's fine in that context. Okay. Emmanuel, go ahead.
Okay, Shay, I was looking at the point of view of they intend to increase their online presence. So that basically means they will need additional investment. So I was looking at cash flow management. In as much as they are raising debt and equity instruments to fund the acquisition of the business, they could easily convert the sales proceed of the that tech side. I forgot the tech business that they are selling. They could easily convert that cash proceeds into that can use it to fund the advancements in the online platform, so as to reduce the amount of cash they are raising through debt or equity, as it's lightening the burden on the shareholders and the business in general.
All right. Yeah. So I'm sure you are saying that because they said somewhere that they will use both equity and debt. Is that why you are saying that?
Yeah, they wrote so that they use equity and debt to fund the acquisition of the business in order to maintain the capital structure.
Yes, so if their intention is to maintain the capital structure, then I think that's fine. If they bring in money from selling, what's the name, Matravers Tech, the question is the money they will use to acquire Matravers Tech, where is it going to come from? So it's really that capital structure, right? So if that money that they then make from selling Matravers Tech is pumped into their online investment, that's fine. I don't think that necessarily means they want to unnecessarily increase their gearing, to which shareholders may not like. Okay, now I'm not sure I heard something about cross-selling. I thought it was very obvious from the scenario where they said something about the out-of-town stores will be also selling both food and home items and things like that. So there may be cross-selling opportunities. A customer that comes for one thing or the other may at the same time be interested in buying the products of the other business. So that's also something you can talk about. Now, still on strategic, do you have doubts around ability to make $5054 million from the sale of tech business? Do you have doubts about that?
Yeah, Oh, sorry.
Go ahead. Go ahead. Go ahead.
Can I come in? Hello?
Yes, please go ahead.
Yes, I think there is, as it is clear here, the strategic intent of selling Matraverse Tech. We've noticed that the information is readily available for potential buyers, obviously, who can try to do their own due diligence and assess if at all the PE ratio is in their favor. Now we can see that in terms of we looked at two lines of businesses in terms of it's different line of businesses. So this seems like it's just an average because it's not showing us exactly how they came up with that PE ratio. Then the second part, which I think might be problematic, is as far as it is clear that they have made up their mind that we're going to sell the Matraverse stake, we are not so sure how the market is going to react in terms of whether they'll be interested in buying, because the period might be also short in terms of when they have now tried to, they have bought, now they're trying to sell. Most people would react negatively in the market, trying to say perhaps there could be some hiccups here and there, some roadblocks and whatever it is, not knowing that it is internally already decided. So I cannot be sure is this this might be a burden, if I can put it that way. We are not so sure that we're going to sell this business within a shortest period of time. There's nothing that is showing us clearly indicating that well, there's a hype in the market. There's potential buyers that are, as much as we spoke about trying to say from the tech point of view, most buyers would say, I don't want to be left out. Now, remember the information is readily available now. There will be a period now where a proper assessment can be done for a potential buyer and try to say, let's get let's compare apples with apples. Let's go into the industry, which is like Matraverse Tech, trying to say, okay, where are we on the PE ratio? If it's not too much in this case, because it will be probably over. And again, because I think we touched areas, I think, where you took us through, where you said, look, by then the market could have reacted otherwise, such that the company could have been overvalued. So I think for me that one stands out, and also the issue of there's no marketing areas which we can, or no indications, if I can put it that way, in the market which can tell us that we are sure it will be like that. So it's just an assumption, which is which is not reliable.
Okay, thank you. So I think three things from your comments. Number one, it's not a strategic fit for our business, so it's okay for them to sell it. That's good. Number two, you've got a problem with the PE ratio that we have used as the basis for the valuation, in the sense that it's an average. And I really like that point. Why? Because what if Matraverse is an outlier, i.e. outlier probably even on the lower end, or it could be on the higher end, we don't know. So the fact that tech business will be sold definitely as an unlisted entity may require that you discount that PE ratio because of illiquidity. Okay, so just picking 18, which is the average tech industry, PE ratio, and using it as the base for the valuation of Matra Tech will be inappropriate. So that's very important. Then the third thing I picked is, will there be buyers? So we don't want to fall into the trap of, acquiring this tech company. It's not a strategic fit for our business, and then we can't effectively find a buyer. So we are locked in trying to manage, the company pending when we can get a buyer, and then it becomes huge distraction for management. So we really don't know how the market will react in terms of buying it based on the assumptions that we have used. All right, that's good. Now, to the final part of this question. What assumptions, have we made that you will want to communicate to the examiner? Chinaya, go ahead.
Yeah, I think I'll just speak to the better assets and how they had made the asset be a weight, like how it had been weighted based on that. That might necessarily not be the case in reality. Then I think additionally, I think is what we already even mentioned it while we were solving the question with regards to the capital structure of the combined company, being same with of the acquirer. I mean, I think we had also mentioned that that might not be the case. Then I think with regards to the growth as well, the growth rates that we have used, I mean, this is what is expected, but then again,
Okay, sorry, it looks like your network. John, go ahead.
Yeah, I think Chinaya has touched mostly on what the things I was going to say, because and from where she stopped about the growth, they've made the assumption that they'll be growing at 2% per year, and that and that what do you call it? They'll be making profits from sales in stores, which may not actually be the case, seeing as a part of their competitive advantage is from online sales. Then around what Brand said concerning the PE ratio as well, the assumption they've made regarding the PE ratio as well doesn't seem would pose some issues really, because they're using an industry average, and when they really start selling Mantra Tech, right, they would have the market would see that, may read that differently to say why is this being sold, and not want to buy shares, which would lead to a drop in their shares as well. So so I think those two assumptions, and I think Chinaya has touched us on the capital structure. So I think that's it for me really.
Okay, good. So lots of assumptions in the question, assumptions about what the profit margin of 6% will be, and that's assumed to be the same forever, 6%. We've made assumptions about the fact that cost of capital, which is cost of debt, cost of equity, will remain flat, in perpetuity. That's usually not the case. We've made assumptions that, as Chinaya said, the asset beta will just be a weighted average of the two companies. Now, the critical thing there that I even want us to consider is the asset beta of Mantra. Which one did they give us? I think is it Westra they gave us, or is it that of? Okay, so they gave us the asset beta of Mantra. Now, guys, watch this. Tech will be sold, but the examiner just said Mantraverse asset beta is 0.75, and we used that as well to re-gear, to calculate the combined company asset beta. But you and I know that this 0.75 is for the old Mantraverse, but not the old Mantraverse will be consolidated with our own entity, because the tech business would be sold. What if the asset beta that should be for the home business is even higher or lower than 0.75. Okay, so that's a huge assumption we made there. Track that number. And obviously, other assumptions like the premium to be paid, that these guys will collect a 15% premium, that may change. That may not be the case. So I guess as part of your conclusion, you can then talk about the fact that there are a number of uncertainties around the numbers that we have calculated, that even though synergy benefits are expected, which would imply that the acquisition should take place, sensitivity and simulation analysis should be performed as a result of changes in some of those variables. All right, so I can send the answers to you guys. Okay, so I just thought let's discuss it so that I don't spend too much time writing stuffs down. Is that the final part of the question? Oh, there's another 8 marks. Discuss the factors which may determine how the offer for Matravers will be financed and hence the level of gearing which West will have. Factors which may determine how the offer for Matravers will be financed, yes, and hence the level of gearing which West will have. Okay, any thoughts on that? Again, you're free to reflect on it. Let's just finish up this question and some final words from me. I don't think we can take another question again. I can just send the question to you. And if you try it, you've got questions, you let me know. Now, if I'm able to do an evening weekday session, maybe to do the second question, I will let you know. Yeah, so what are your thoughts on the C part?
Hello? Hello, Shay.
Yeah.
Okay.
Can I try? Okay, so I'll start from I'll build my case like this, and it is cheaper to finance such acquisition based using debt finance, as it has a lower cost of capital based on the fact that the interest is tax deductible. However, funding such acquisition with with debt increases the gearing ratio, which the shareholders may not be open to. This may have led the entity to deciding to use a combination of debt and equity instruments. So at this point, they will basically be raising additional debt to increase their debt capacity, and they'll be raising equity instruments. So then the equity instruments can be they can raise the fund using rights issue or issue new shares to the public. But so I'll talk about the top sides of rights issue, that the existing shareholders will retain their current market capacity, their current level of control, on the assumption that they all subscribe to the right issue. So this will ensure that they did not dilute their control of the business, and they still, in essence, technically retain the same the same earnings that is collectible by them. Like for example, if everybody increased their if everybody subscribes to the right issue, they will just basically have an increased number of shares, but a percentage increase, their percentage is still the same percentage holding in the company. So when they are sharing earnings, they still have that same percentage return on their investments. So that is for the right issue, but the downside that it may lead the current shareholders to dip into their pockets to bring out funds, which may be a hard ask for them. So then the other part is about talking about issuing shares to the public, which is a good thing because it doesn't give the shareholders the financial burden of raising capital. They just have to bring more shareholders into the business. However, it may lead to dilution of their control and their earnings from the business. And yeah, so now I'll talk about the shares, then the debt equity. So then talking about the debt instruments, I'll look at factors like
Emmanuel, hold on, calm down.
Sorry.
Normally, I like points being organized. Okay, so if you want to talk cost, say cost. Talk about your point. Then number two, this. Talk about it. The way you are talking, I'm not sure I'm following you. And I have a feeling.
Just talking at the way it's coming in my head.
So that's why I said don't write the way it's coming to your head. It's important to just jot them down, okay, so that you can organize your thoughts. John, go ahead. I see your hand up.
Yeah. Okay. So for me, I think the way to go, because what I did was I did a quick computation of what West Pali's debt to equity is right now. I think that's like around 114%. So going for a debt method of financing might not be the best because you're already at a high level of gearing, right? You might want to issue equity in financing this so that you reduce your level of gearing and you don't really have too much leeway in terms of increasing your gearing if you're at 114%, because your current debt holders would have financial covenants which may kick in.
Yeah.
Right. So but then we'll also talk about the implication of an equity financing on West Pali's financials, right? In the sense that it would affect certain ratios such as your EPS and it might lead to what you call the dilution of control, like you pointed out earlier. So those first 2 points are what popped in my head, and yeah.
Okay, good. So yeah, I've taken note of that. What else? Bilkis, go ahead. After that, branded.
What I thought of is that they could want to follow. I don't know if it works though, but I just want to say it. They could want to follow this pecking order that okay, let's see if we have retained earnings, since that would not cost them anything or probably it will not cost them much. So if they have enough funds and in cash, they might want to use their retained earnings. Then if that is not enough, they could now go for debt if it is still if they can raise debt and then go for equity. So then the equity is, I think those people that spoke earlier have said a lot of things on it, that if they could decide to issue more shares, if their share price is high, and if they don't want to reduce their shareholders and they don't want to dilute their holding, they can decide to give right issues to them. That's one. Then they can also, it's also possible that the managers of Westpal, they have preference for, okay, probably they have preference that for if they want to invest in this type of whatever, there is a particular source of fund they already have attached to it. I don't know if you get what I'm trying to say.
Yeah.
So,
okay. So thanks for that. So I've heard some points. Brandit, go ahead while I take note of some of those points.
Okay, I think regarding the availability of finance, the time factor also might be an issue. It depends how quickly they want to make an acquisition, because the availability of finances may also be a significant issue. Equity-wise, it may take a little bit of some time because there must be certain approvals to be done, like from the shareholders themselves, for instance. But now also the financial providers, Westbury must be overcommitted with other financial providers. So they might also have a challenge in that area. So the time factor must be put into consideration, trying to say how quickly do we really need to acquire this? But it won't be. It will be a challenge. The financial providers, like financial institutions, like I said, they might say, no, you are overcommitted. So it could be a challenge of which the renegotiations need to kick in again in terms of the long-term debt itself, trying to say what is the period. Now we have to consider that obviously that will also affect the cost will also go high, because if they are overcommitted, you see that the loan might be issued at a higher interest rate. And so it must be carefully thought about by the shareholders in this case. So now on the other point, I would think, of course, a mix would be considered. But however, again, also we have to consider the risk appetite in terms of the shareholders, trying to say where do they want to fall if the gearing, like my colleagues, my friends have said there, if the gearing is too high, because they might have challenges with the current cash flows, which we have spoken about on the cash flow, trying to say, look, the assumption is also not convincing that there will be a steady increase. And talking about those areas, there could be quite a few things which might affect the the financing itself. So
okay,
it would be a challenge. Thank you.
All right, thank you. So pretty much we all agree that we have to look at their current gearing and the fact that it's already high. Someone gave us the figure, debt to equity. It may mean that if you have to do that same thing. But by the way, I didn't even ask John, which debt to equity did you say you tried to estimate?
It was based on
Combined.
No, for West Pali alone.
Pre-acquisition, right?
Yes, pre-acquisition.
Okay. So we calculated those numbers. All right, good. So its gearing levels are currently high. So higher gearing or borrowing more again may depress share price. Okay, depressed share price. Okay, so it may affect the share price of the entity, and obviously, the shareholders will not like that. But more importantly, borrowing more may have other consequences. Things like restrictive covenants, that may reduce the financial flexibility of the entity, and not only financial flexibility, but operational, flexibility to be able to take on more risk.
If I may add, sorry, my hands have been off since, but it seems you noticed me.
Oh, okay. Sorry.
Yeah, sorry. If I may add, I think we also have to take into recognition the preference of the various shareholders. That is the preference of what's their name? Mataverse shareholders, if they want cash or they want equity in West Pali in
Yeah, good point. Yeah. Preference, because they may actually prefer equity. Preference of payment option, or preference of Matra shareholders regarding payment option. or payment method. So if they believe in the post-acquisition fortunes or prospects of West, then they may prefer share exchange. Otherwise, they may want you to pay them cash and things like that. So cost. So debt may be cheaper. So while you may start with debt is cheaper, you may also want to highlight the fact that the current high gearing may make debt prohibitive or make it difficult for them to get low cost. So it may actually, remember, traditional view of capital structure says your gearing gets to a point where both debt holders and equity holders themselves may be asking for a higher return. Okay, then obviously availability. So I like the point Brand raised on availability because some of these investments are time-based. You guys talked about loss aversion bias earlier on. There may be other parties too that are looking at matravers. So you may need to do this quickly, in order to ensure that you are still able to proceed with the acquisition. But then the question is the kind of capital, debt capital you will need for this, given your current level of gearing. Can you easily raise that amount? Okay, easily, and also will equity not take more time? Okay, unless we're talking about private placement, but remember that this is a listed entity, so typically you will need some form of regulatory approval, or if you even have to do a right issue, whatever it is, it will take some time before such funds can come in. So it's important to consider that. Overall, debt may seem faster, except for the fact that it may take some time to land the kind of amount you need, given the concerns around your current gearing. And perhaps maybe one of the things we also need to know is timing of repayment of existing debt. Timing of repayment of existing debt. So if, for example, the existing debt that West has is due in the near term, 1 year, 2 years from now, then there may really be serious concerns about their ability, to meet up, given the huge commitments they already have. So a combination of these factors. I also have your industry gearing levels. So you also want to ensure that whatever you are doing, you are not too out of touch in terms of average industry gearing levels. Because if you are, then shareholders and debt holders alike will start perceiving the company as being high risk, okay, within your sector, and that may affect share price eventually. So you can also reflect on that fact. All right, I think that's it on that side regarding this question. Yeah, so what are we going to do next? Just to wrap up on some of the things that we have said. Number one, if you were not in our class, sorry, just give me a moment. Let me project another thing. Okay. So where are you? Yes. So back to my Excel. So if you look at this, I will also drop it on your groups. So what we have here, pretty much the questions for the last 11 diets, 11 exam sittings, identifying the predominant topics that were tested in each of these areas. And obviously you can see the consistent patterns in terms of what was tested. So what we covered today is West Palace, sorry. So that one is out, so we can effectively paint that green. Now, my intention was to take another question outside this period. So, but our time cannot permit us to do that right now. So my suggestion, please, if you are preparing for your exam, you could as well use this. Pick some of these diets, do them as mock exams, do them on Excel and word processor, even if you can use test rate, and then mark yourself based on the examiner's feedback or answer. And also the recommendations we got around study groups. You guys can meet, pick a topic, have a discussion around it, or solve a question together, or any problem question that you have identified, solve it together. If you need further clarity, drop it on the group, and we will be happy to guide as the case is. But be careful with study groups. You also don't want to have too much inefficiencies, in terms of study groups. So yes, obviously you would have to sacrifice time, because what you are not thinking of, another person may mention it, and that may be what you will need, what you will remember in the exam hall. But at the same time, if you guys want to meet, ensure that you have a well laid out objective, so that you stick to that objective. If it's 2 hours, if it's 3 hours, you do that and you leave, and not just perambulating around the same thing without achieving much. But study groups really do help. Okay, I guess I don't have any other thing. Everything I want to say, I've said them. Is there any other question?
Yes, Shay.
Yeah.
I asked about, I don't know how you can find time on the issue of swap. Cross rates.
Oh, yeah. You asked a question on cross rates.
Yeah.
What was the question again?
For example, in Washiko, there is the rates they gave, they are like, what do you call it? They are spread on the left, on the right, another one on the left, on the right. So how they have to manipulate the two sides was confusing. So I just want to have the understanding.
Okay. So what you are saying is, for example, they gave you, sorry, just one moment. They gave you
Japanese yen to euro.
Sorry, no, let me just use, so they gave you 100 to 120, let's say, naira per dollar, right?
Yes.
And they give you dollar, let's say 1.2 to 1.5 dollars per pound, and they wanted you to calculate the rate for naira to the pound. Is this something like this?
Yes.
Okay, so okay, the thing with this is this. Let me first of all explain something. The idea around cross rates is to use one side to get the other. So for example, if I pick the mid quote here, say 110 naira to the dollar, and I pick the mid quote here, say 1.3, let's just say 1.3, $1.3 to the pound. So if I'm now asked to get naira to the pound, what I will typically do here is to check which currency is stronger, at this point. Definitely it's the dollar. Which currency is then stronger between the dollar and the pound? Definitely it's the the pound. So I will put 110 times 1.3, and that will give me something higher. I don't know what that figure will be. So, but whatever it is, 30% more, so that's likely to be around 133. So 133 naira per pound. So the idea generally around cross rate is your ability to use two rates that is available in the market to estimate another rate that is not available in the market. So in the question that you are talking about, you seem to suggest that they have given you the rate not as a mid-market quotation such as this one, but in terms of bid and ask, which is the buy price and the selling price. And then your question is, okay, so what will be the quotation on both sides for what's the name, for naira to euro? So to be able to do this, you will have to also cross the rates, okay? You would have to cross the rates. So for example, in this kind of scenario, let me just check this in terms of which is more. Okay, so if I want to get the dollar, yeah, so that's 1 4 something, 150, yeah. Okay, so first thing is this, my friend, first thing is you have to decide based on the rates given to you. And remember, in AFM, rates can be given anyhow. And remember, I always also tell you that when you are given rates in this format, there are two decisions you need to make. Am I dividing or am I multiplying? Is that not true? Then the second decision is, am I buying or am I selling? Obviously, I've not given you details on buying or selling here. That's not really our objective. The main thing you will need here is, am I dividing or multiplying? Okay. So given that Naira is the much weaker currency than the pound, the decision is for me to multiply. Okay. So in this scenario, but the bottom line, you have to cross the rates. Okay. You can't do it this way. Okay, so this way will be wrong. Do you get my point? Because one is the rate at which you will buy, the other is the rate at which you will sell. If in reality you want to do this and there's no quotation for Naira to pounds, that means you would have to carry your Naira, first of all, convert it to dollars. What will that mean? Will you be buying dollars or selling dollars? You will be buying dollars. Is that not true? Okay. So let's say that is 120. I mean, in terms of what you will pay to buy dollars. Then when you now have the dollars, what will you now do to the dollars to get pounds? You have to sell the dollars. You won't buy again. So that's why you can't do right to right, left to left. Okay. So if I'm a Nigerian and I need pounds, so what do? I buy dollars, okay, and then the proceeds from buying dollars, I will sell the dollar in order to get pounds. So one rate will be on one side, the other rate will be on the other side, okay? So for example, if I need to sell dollars here, that will be in terms of how much pounds would I receive. You obviously know that it will be at 1.2 because you will receive lesser amounts. Okay, so 1.2. So that will be 120 times 1.2. That gives me a value. Then the other one will be 100 times 1.5. That gives me a value. This is my quotation. What will this figure be? 20% of this. Is that 144? Or 124? I don't know. You can check.
144. 144.
144. Okay, 144, then 150. So this is what it will be. So that's just the more important thing. Always remember. So if, for example, let me take you through it again. If, for example, I need to get pounds and I'm a Nigerian, I would have to buy dollars. If I have to buy dollars, what would I pay here? Is it 100 or 120? It will be 120. Is that not true? Remember, I will pay more to get what I need. Now, if I now have dollars, let's say $1, I now need to convert this dollar to pounds. So what would I be doing? I will sell my dollars in order to buy pounds. Is that not true? So which of the two rates would apply? Certainly nobody is going to give you, you would have to divide, right? Yes. Wait, $1 divided by 1.5. 1.2, 1.5. So that should be 1.5 actually. Yeah. So that gives me how much? Can you help me calculate it? $1 divided by 1.5. What does it give?
0.67.
0.67 pounds. Okay. If I do the other way, Naira, if I have, okay, so this is Naira to pounds. If I have pounds and I decide to sell it, I hope the rates I'm using here are correct. But the main approach is what I've just told you. Just cross the rates. It will be complex if they've given you 3 different currencies and you're trying to get one. But as long as it's just 2 different currencies, you know, decide whether you are dividing or multiplying and then cross the rates. Whatever you get will give you the bid and ask for the reference currencies that you need. Do you get that, please?
Yes, please. I do.
Okay. All right. Bilkis, go ahead.
Please, I just want to ask, our answers, like if we calculate discount factor, do we have to make our answer be in a particular discount, deposit, decimal points? As in, can it be in 2 or 3, or is there a particular
No,
one?
no, it's not so much, but I think 3 decimal points is the standard. Okay.
But on test street, is it possible on 3 decimal? Because I can only see 2. I don't know if anybody can help. I've been trying on it, but I've been seeing 2 decimal.
There's a way you can do it. After a long time of searching, eventually saw it.
Wait.
Please, can you help?
Wait, hold on. I'm wondering, why do you need discount factors?
Okay, Shay, you know, when we are doing the discount factor and you type it, it will give you, for example, if it's 0.89, whatever, you only see one. It's only one you see, unless you have to expand it to decimal.
No, Shino, hold on. That's not my question. My question is, why do you need discount factor? It's an absolute waste of time. Discount and get your PV straight up. Discount factor does not earn any mark. Okay, you don't see me put 0.909, 0.847 or anything. I just get my cash flows, use the rate on it, pick the year, and I get my PV straight up.
Okay, that's possible though, but I'm asking, okay, it could be for any other thing. It might not be for discount factor in particular, but probably your answer is decimal. I just want to know, because I've been trying it. You have been trying it on test it. I've not been able to see 3 decimal. I've been seeing 2. That's why I asked. If it is not material, then just leave it at 2.
If you have 2, it's fine. But if someone knows what he did, they can also share that. But 2 is also fine. Any other question? Okay, so our last meeting officially will be the mock debrief, which is this June 2019 diet. So that will be happening based on the timetable that will be sent to you guys. I think mock debrief are 2-hour classes in the on weekdays in the evening. So just watch out for that. It's not solving a question, it's just pointing to the general mistakes that we observed and what you should avoid for those questions that you attempted. Thank you very much for your time. I think you have what it takes to go and prepare, do the last minute preparation. I think that's good for today. So we will keep exchanging chats. Bye-bye.
Thank
So
you
we
so
don't have
much.
today.
Thank you.
Thank you.
Hello.
Bye-bye.
Thank you,
We don't
Shay.
have class Saturday.
You don't have what?
We don't have class this coming Saturday.
No.
For AFM, no, we don't.
Okay, thank you, Mr. Shay. So
Thank
grateful.
you.
Thank you. Thank you.
Thank you, Shay. Thank you.
Thank you.
Bye all.
Bye.
Thank you.
Bye.
Shay, sorry, will you be able to share this Excel file with us on the group?
Yes, I will. I will share it.
All right, thank you.
Hello, Shay.
Yeah.
Can you drop? You said you are going to send the option pricing video.
Yeah, I will share it.
Okay, thank you.
Yeah.
And something on securitization.
Yeah, true. I will share it. Thank you.